$100 a month. That's $3.30 a day, less than the drink you didn't need this morning. Invested from age 25, at the market's long-term average return, that becomes $632,400 by retirement. Not a typo. $632,000. From $100 a month. And a brand new CNBC report says regular people, not finance bros, are finally figuring this out. Meet Maya. She's 26, lives in Columbus, makes $48,000 a year doing marketing for a mid-size company. After rent, her car payment, groceries, and her student loan minimum, she's got maybe $250 of breathing room a month. For years, Maya believed the same thing most of us were raised to believe: investing is for people who already have money. Her plan was, I'll start when I get a raise. Then last week she saw this CNBC headline: more low and middle income Americans are investing than ever before, largely because apps killed account minimums and fractional shares mean you can own a slice of the S&P 500 for the price of lunch. Her coworker Dev, who makes the exact same salary, has been quietly putting $100 a month into an index fund since he was 23. He's not smarter than Maya. He doesn't earn more than Maya. He just started. And that one difference, starting, is worth more than most raises Maya will ever get. Today I'm going to show you exactly why, with real math, and then give you one thing to do before dinner. Here's the mechanism, and I want you to actually get this, not nod along, get it. Compound growth is a snowball rolling downhill. Year 1, your $1,200 of contributions might earn you $60. Honestly? Boring. Feels pointless. But here's what nobody tells you: the snowball doesn't grow at a steady pace, it accelerates. Your gains start earning gains. By year 20, the snowball is adding more per year than you are. By year 35, your money is earning multiples of your annual contribution without you lifting a finger. The hill does the work. Your only job is to push the snowball early and then not stop it. This is why income matters less than time. Dev at $48,000 who starts at 23 beats a $150,000 earner who starts at 40, not sometimes, mathematically. Now, the objection I hear every single time: but what if the market crashes? Here's the honest answer: it will. Probably several times over 40 years. But since 1950, the S&P 500 has recovered from every single crash and gone on to new highs. If you're investing monthly, a crash is actually a discount. Your $100 buys more shares when prices are down. The only people who lose in crashes are the ones who sell during them. Time in the market beats timing the market, and the data is not close. That CNBC report matters for one specific reason: the excuses got deleted. 10 years ago, plenty of brokerages wanted $1,000 to $3,000 minimums just to open certain funds. Trades cost $7 to $10 each, brutal when you're only investing $100. Today? Zero minimums, zero commissions, and fractional shares at Fidelity, Schwab, and Vanguard. A single share of some S&P 500 ETFs costs over $500. Fractional shares mean your $100 buys 0.2 shares, and it works exactly the same. That's why lower-income households are entering the market. The door that used to be locked is standing wide open. The people still standing outside aren't blocked by money anymore. They're blocked by the belief that they're blocked. Maya's $250 of monthly breathing room? 100 of that is her ticket in. She doesn't need to become a stock picker. She needs one boring index fund and an auto-invest button. Okay, let's run the real numbers, because this is what we do here. Scenario 1, you're 25, you invest $100 a month into an S&P 500 index fund, and it returns the historical long-term average of 10% annually. Over 40 years, you contribute $48,000 total. The future value formula on 480 monthly payments at 0.833% per month gives you $632,400 at age 65. Read that again. You put in $48,000, the market adds roughly $584,000 on top. Now scenario 2, same $100 a month, same 10% return, but you wait until 35 to start. 30 years of contributions, $36,000 out of pocket. Final number, $226,000. That 10-year delay didn't cost you the $12,000 you skipped contributing. It cost you $406,400 in ending wealth. Every year you wait in your 20s costs you roughly 40 grand at the finish line. And if you want the conservative version, say the market only averages 7% going forward, which is below its historical average, that same $100 a month from 25 still becomes about $262,500 by 65. Worst case in that model, you turn $48,000 into $250,000. One more, bump it to $200 a month at 10% from age 25, and the number becomes roughly $1.26 million. A millionaire on $200 a month. The variable that matters most in every one of these calculations isn't the amount. It's the start date. And the only start date you control is today's. So here's your one action step, specific, executable, under 5 minutes. Go to fidelity.com, click Open an account, choose Roth IRA, that's the one where your gains grow tax-free forever, and you can open it with $0. Once it's open, search FXAIX, that's Fidelity's S&P 500 Index Fund, no minimum, 0.015% fee, basically free. Buy $100 worth. Then go to Automatic Investments and set $100 on the first of every month. That's it. You just did the thing that separates the $632,000 version of you from the version who kept waiting. If this was worth $100 a month to you, subscribe. I drop one money idea every single day. And put your money question in the comments. I read every one.